Central banks from the world's leading economies are set to announce key monetary policy decisions this week, and these moves could immediately impact risk assets, including Bitcoin and real-world assets. Here's what investors need to know right now. Okay, looking into this central bank's meeting table, you can see the schedule of the leading world economies are reconvening this week on whether to continue to drop their fund rates, which is the expectation from the world's capital financial markets. You can see that there are key monetary policy committee meetings from the Fed this week, including the Bank of Canada, the Bank of Japan, the Bank of England, and even the Bank of Brazil are all convening this week on making those long-awaited fund rate cuts. Now, this comes to show that even the Fed, the ECB, the Bank of England, the Bank of Canada, even the Bank of Japan are all in easing mode. That means liquidity injections, cheaper borrowing, and fresh demand for scarcer assets. When central banks cut, hard assets pump. Bitcoin benefits directly from lower real yields, and real-world assets become more attractive to institutions hunting yield. Now, it's not just one bank as we're seeing from this table. It's a synchronized policy shift, which is very rare, and it signals a supportive macro backdrop for the next leg up. So we're officially in the cheap money era, and we're not going to see the end of this train journey. That we're going to continue to be seeing more rate cuts, not in the September meetings, but in the rest of this year, and even as far beyond to Q1 and Q2 of next. So what's the Bitcoin signal here? We've got central bank fund rate cuts taking place versus the actual performance of those bond yields. Now, you've got the rather interesting chart in front of you that illustrates an example of the current US Treasury yield versus Bitcoin, where you have the rate of return of the current bond yields and interest rate percentages shown in green across time. So the depiction shown in this chart is rather interesting because it shows you consistently the trend of the bond returns hasn't really caught up with the actual evolution of the Bitcoin price over time. We are seeing consistently the Bitcoin price overperforming the bond yields because they aren't attractive. So this illustrates any assets worth holding, it should at a minimum outperform this meager return shown in the green, which is the current yields of the bonds. So the setup here is we're going to be seeing the Bitcoin bulls are betting that Fed rate cuts will actually push these bond yields lower, which would ease financial conditions and fuel a renewed crypto rally. So where there's lower yields, it will mean cheaper capital to borrow, injecting more liquidity into the market, and historically stronger bid for Bitcoin as manifested in this chart here. So you got the table here that's shown in the case of the US national debt, the continuing rise of its national debt up until present day, almost $36 trillion. And this is dated back in the end of September of last year. So there's more borrowing that's taken place. So what's the catch here? Even if the Fed cuts rates, massive government borrowing and stubborn inflation could keep long-term yields actually high, limiting how much relief markets will actually feel. So what's the upshot of this? We need to remain focused on those 10-year yields. If they actually fall in line with rate cuts, Bitcoin's tailwinds get turbocharged. If not, the digital gold hedge trade becomes the driver instead. So either way, the Bitcoin stays in the macro spotlight, which is the key point here. Now moving into a major spotlight in real-world assets, tokenization, this article shows that Fidelity has launched $202 million worth of tokenized money market fund, FDIT, which is the ticker symbol, on Ethereum, marking its first major on-chain entry into the US Treasury-backed digital asset. So the rapid growth of tokenized treasuries, the $7.5 billion mark, has actually tripled in a year, shows institutional real-world assets are increasingly moving on-chain, creating new yield and collateral infrastructure for crypto portfolios. So yet again, we're going to be seeing a lot of more news and movements and bullish sentiment on real-world asset tokenization, as I have actually explained in many of my videos before. So as an upshot to this short snippet video, central banks are cutting, Bitcoin supply is tightening, and real-world assets are scaling. So macro plus scarcity and adoption is the trifecta for this cycle. So subscribe and catch the full Friday desk review for this big picture. Until next time.